This video is going to be talking about just some basic real estate terms that we run across in the investment community. And if you find it helpful, guys, take a minute and like the video. You got comments about things, take a moment and comment below. And don't forget to take a moment and subscribe to our YouTube channel. So let's start off with some basic terms for the real estate investment industry out there. And the first one, of course, that you need to know are some sale terms. So this means you're selling a property. What does it look like? How do you find various sale scenarios? The primary one is a retail sale. What does that mean? That means selling a home on the open market through traditional mechanisms to a third-party buyer who is not an investor. Then there is wholesale or wholesaling. Now, this could mean selling at a discount, but typically the word wholesaling in the investment community means flipping of a contract. You put a house under contract and you sell the contract. You're not selling the property. Another one that's out in the industry is wholetailing, kind of like wholesale and hotel, which is a strategy used by a lot of investors where they do some of the work to a property so that it will get to a certain standard level, maybe so it will pass appraisal standards, but it is a below full retail standard. So for instance, instead of selling a home for $100,000, you might sell that same house for $85,000. But maybe you put in $25,000 less amount of work to the house to be able to get it up to that standard. That's so that the end buyer can do the work themselves. Another term you must be familiar with is seller carryback, which is part of a sale scenario. And this is where the seller acts as the bank, which means they could carry back either a first lien mortgage on the property or a second or third lien mortgage. In other words, you might get financing through a private lender, a bank, a mortgage company, but you still need some additional dollars, and the seller can agree to carry back all or part of the purchase price. So let's take a minute and talk about valuation terms and some basic mortgage terms regarding investment properties. The first one is ARV, which stands simply for after repaired value. Simply means what is the market value of the property after all repairs have been done to the property to put it in good workmanlike condition, ready for the open market. The next is LTV, which stands for loan to value. So loan to value simply means is what is the amount of my loan versus what is the property worth. So if the property will appraise for $100,000, that's your value part, and maybe you only borrow $80,000, your loan to value is 80%. 80,000 divided by 100,000. Another term out there is LTC, which is loan to cost. So let's use that same scenario. That house has an appraised value for $100,000. Let's say you buy it for $80,000. Maybe that's your purchase price and repairs all combined. But the bank only wants to lend you $60,000. So loan to cost is $60,000 divided by 80,000. So in that instance, that would probably be 75%. Another term out there is carry cost. Carry cost is the cost of your loan while you're holding that property before either you sell it or before it becomes income producing for you. Carry cost usually is at least the interest on the property you're paying on your mortgage if you have one. It might be interest only or principal and interest, and oftentimes it is taxes and insurance as well. And you take that and maybe that's combined over 2, 3, 4, 5, 6 months more, and that would be your carry costs on that property. That's an important term for investors to understand because it takes money directly off of your bottom line. Another term you'll come into line with is ad valorem taxes. Everybody goes, what the heck are ad valorem taxes? Very simply put, property taxes. It's just a name that they use for property taxes, unfortunately, out in the industry. So let's take a minute and talk about creative finance and creative finance terms that are out there. First off is subject to. What does that mean? Well, that doesn't mean assumption. Subject to means you're buying a property subject to any debt on the property. And typically, it doesn't mean that you are assuming those loans, but you're agreeing to make payments towards those loans, whatever they might be. A mortgage loan, a judgment lien, IRS lien, or other type of liens on the property. So, assumption. Well, in that word, an assumption means that the buyer actually goes to the lender of record, the mortgage holder, and they qualify for that loan and assume the loan and take over the payments so that the seller is released from liability. In the subject to category, the seller is not released from liability, whereas on the assumption category, they are released from liability. In today's marketplace, assumptions are usually very rare in the open market. Another term is wraparound mortgage. Now there's several types of wraparound mortgages. A traditional wraparound mortgage means a loan to a third party that is secondary and subordinate to, meaning it wraps around an existing mortgage. So for instance, you owe $100,000 to a mortgage company and you sell the property for a $200,000 loan. The $200,000 loan wraps around the $100,000 loan. Now that wraparound mortgage can be for a greater amount of money as the situation was. It can be for a different interest rate as well as a different term than the existing first lien mortgage. Another wrap term is mirror wrap. Well, a mirror wrap means that the wraparound mortgage is for the exact same terms, conditions of the existing first lien. It's just that a new note and deed of trust are being executed from the buyer to the seller, as opposed to an assumption mortgage or a subject to type deed of trust. So a mirror wrap would have the same loan balance, the same interest rate, the same number of payments due, and the same monthly payment, principal and interest due, as the existing first lien mortgage. You'll hear the word option in the industry, and an option is simply that. It is an option for the buyer to buy the property. There could be an option fee associated with it where you put up $1,000, $5,000, $10,000 or more for the right to buy the property at a time in the future for a set price today. Now normally it means you have to obtain new third-party financing and pay the seller cash for that option to buy the home. You may run into the term lease purchase. And a lease purchase is very similar to an option in that the resident is leasing the home. They have a chance to buy the home for a particular set fee today in the future, but now they're getting a piece of the lease amount credited to the contract amount. So for instance, if your price is $100,000 to buy the home 2 years from now, you're leasing the home for $2,000 a month, the seller could give you a credit, let's say for $500 per month. Every month you make your payments in a reasonable and timely fashion. So at the end of 24 months, you've built up $12,000 that the seller will apply to your purchase price, your closing cost, or other fees related with you obtaining a mortgage to buy that property. You may hear the term lease option, which is where you are combining a lease with the option to buy. Similar to the lease purchase, but different in that usually there are no contributions being made by the seller to the buyer. There's another term in the marketplace called executory contract. And an executory contract is a contract to be performed in the future. An option contract is a form of an executory contract. A lease purchase agreement is a form of an executory contract. A contract for sale is a form of an executory contract as well. Now, oftentimes though, when we use that term, it's not relating to those items, but mostly it is pertaining to a contract for deed, maybe an all-inclusive deed of trust, maybe a land contract. Now those are different terms, but oftentimes they mean the same thing. Another term can be agreement for sale as well. And these are all the same different terms for the same item. What this simply means is, Mr. Buyer, when you pay the seller 100 payments of $1,000, they will then provide you a deed to the property at that time. It's something to be done in the future based upon a performance to be done by the buyer. So similar to an option, but the option usually relates to obtaining third-party financing to pay cash for the home. The executory contract for deed comes into play, where the buyer is making monthly installments, and upon making the final installment, they then get the deed to the property in the future. Let's take a minute and talk about the title industry. So in the title industry, there are many levels of title evidence. The simplest is a simple title search, and that's just a precursory search of the title that's out there. It can be in-depth or not as in-depth, and it's not as sufficient as most investors, attorneys, and title companies would want to see in a transaction. The second level is an abstract of title. And an abstract of title is very akin to a title commitment. When you go to a title company and you open title on a property, as we call it, that means they will go through and they will pull up the title evidence. They will present to the buyer a title commitment, which tells you who the owner is, the legal description, any items that may affect the property that will not be removed, and then there are other items that will affect the property that must be removed. Normally in the title industry, you're looking at the title commitment at Schedule C. Those are items such as existing mortgages or existing liens that may affect this property that need to be removed prior to you buying the home. Now, an abstract of title will read very much like a title commitment, but it's not going to have any associated title insurance with you. Now, with a title commitment, that traditionally means that you're going to be obtaining title insurance. So what is that? Well, title insurance is where an actual insurance company ensures that you have fee simple or full ownership of that property, subject to any disclosed or agreed upon liens that will remain on that property. Normally, if you're buying a property and getting a new mortgage, that new mortgage, they'll be insuring the title of the property. It says you own the home free and clear of any and all liens, but for the new mortgage you're putting on the property. Now, Schedule B of a title commitment and a title policy will also show you those items being left on the home, such as easements and maybe oil and gas leases that might have been executed previously that may affect the home in some format that you may not have issues or title with. So you need to understand the different levels of title insurance out in the marketplace so you know what to ask for. And by the way, as you go down that pecking order from a title search to an abstract to the commitment and title insurance, each one does cost more money along the way. Let's talk about hazard insurance. So when you're buying a property, you want to get insurance to protect your property. First off, if you're paying cash for a property, you don't have to get insurance. It's probably a smart thing to do, but you don't have to do that. So with hazard insurance, there are various levels. You can get what we call a simple fire policy. That means that insurance policy protects the property from fire only and nothing else. Be cautious not to get that. Lenders do not accept that, and you should not either. The next type of policy is called a fire and EC policy. EC stands for extended coverage. So it covers fire, but it also covers wind, hail, storm, rain, things of that nature, tornadoes along the way. A fire and EC policy is typically associated with a non-owner occupied property that is going to be usually tenant occupied. And in those cases, it covers the structure but not the contents of the property. Now, you can have a fire and EC policy, or you can have a fire and EC policy with tenant vacancy clause added, because if the property goes vacant and is vacant for more than, let's say, 30 to 45 days, the insurance company requires you to put a vacancy rider on that policy if you want that added protection. Because if you do not have that added protection and there's a loss, you may lose your coverage. Another type of insurance that is used in the investment business is called a builder's risk policy. This is used when you're buying a property and there are usually substantial repairs being done to the home. The builder's risk policy is for a set time frame, usually 3 months, 6 months, 9 months, a year. Typically, those premiums are non-refundable once you pay for them. And what it does is it puts the insurance company on notice that repairs are going on because there could be some more risk involved. It protects the structure just like a fire and EC policy does, but gives you some added benefit for the loss and damages if items are stolen or other damages are done while the house is being worked on by your contractors. Let's take a minute and talk about rental properties and rents. So first off, in the rental world, that simply means you're leasing the home to someone who's going to occupy the house as a tenant, not a homeowner. Now, there is a standard lease. You're going to find those the same in all communities, and those leases can be for a month, a year, 2 years, maybe 3 years. You can have a temporary lease. And a temporary lease might be a buyer's temporary lease or a seller's temporary lease when utilized with the purchase and or sale of real property. For instance, if you're buying a property and you need to move into it before you actually close on it, that's a buyer's temporary lease. If you're going to sell your property but you need some time to move out, that's called a seller's temporary lease. In both those cases, it's usually for a reasonably short time frame, a week, 2 weeks, maybe a month, giving the buyer or seller the time to close the deal or sell and move out of the home. Now, there are other terms for leases in the marketplace. You'll hear terms such as short-term lease and mid-term lease and full-term or long-term lease. Now, a short-term lease is a lease typically defined as for a number of days. This is what you're going to find in the Airbnb world, where people are leasing homes very similar to a hotel room. The mid-term lease implies a lease that's typically going to be for a different time frame. Instead of a long-term or a full lease that might be typically for a year, this might be a lease that's for 3 months, 6 months, 9 months, or it could be for a longer term. But it's done in that format because you're going to get more money because of the short-term nature of the lease that's out there. Now, a mid-term lease arises from situations such as maybe nurses who travel from hospital to hospital. We call those traveling nurses, who may need to stay in a house for 3 months or 6 months for the term of their contract. It might be used by an insurance company who is putting a family in a home because their house had some catastrophic loss. There was a fire and the home is currently being renovated, but they need a place to live. So instead of putting them in a hotel, they put them in a mid-term rent of a single family home that is similar to what they were living in along the way. And then a long-term lease is what we described in the beginning, which is usually for a full term up to usually a period of 1, 2, or 3 years. Let's talk just a moment about evictions, because this is a term that is used in the landlord-tenant world a little bit. So an eviction is a lawsuit that is usually filed in a justice court. We call those sometimes JP courts, Justice of the Peace, which is to remove a resident from a property who has either not made their payments or has stayed beyond the time of their lease term. With an eviction suit, there may be various notices associated with that you must provide. A 1-day notice to vacate, a 3-day notice to vacate, or a 30-day notice to vacate, or different based upon what a lease might say. If you're in the justice court and you win, your tenant could appeal that case, meaning start over again, in the county court typically. Different jurisdictions may call that a little bit different. But it's usually the last form of court that a tenant can go to without going into the Court of Appeals on a legitimate appeal process. Along the way, if you win a eviction suit, you have to wait a prescribed time frame. Sometimes it's only 5 days, it could be 10 days in some places, where that judgment then becomes final. Once you have a final judgment, that judgment typically cannot be appealed. You can then work on your remedies. So what are remedies in the eviction process? The first one is called a writ of possession, which means you've evicted the tenant. They refuse to move out, so you file a writ of possession with the justice or the county court. That writ is delivered to a constable who will normally deliver a 24-hour move-out notice to the resident. Once that happens, various things are put in place so that you can then go out and with the constable's supervision, remove them, and if necessary, forcibly from the property, and all their items are placed on the curbside. Another mechanism in the eviction process could be a writ of garnishment. So if you get a money judgment against your tenant for non-payment, it's possible you could file what's called a writ of garnishment and actually garnish their bank accounts, if you know what those are. And any money that is in those accounts might be captured to pay the judgment that you have. Another remedy is called a writ of attachment, which instead of attaching a bank account, which is what a writ of garnishment does, it goes out and it can attach to non-exempt personal property. If they have 2 cars here in Texas, it could attach to 1 car. If they have 2 trucks, it could attach to 2 trucks or to one of the trucks. But if they have a truck and a car, it won't attach because here in Texas, the Constitution doesn't allow that. They're exempted in that scenario. And various other items that could be attached to help settle the debt and the judgment that you hold against the tenant. If you found this video helpful, don't forget to take a moment and like it. If you've got any comments, comment below. We'll do our best to answer those questions for you. And don't forget to subscribe to our YouTube channel as well. We'll see you guys next time.